All right, guys. We're going to jump to chapter 6 for this week. Skipping chapter 5, we'll come back to chapter 5 if we've got time for it. It chapter 5 mainly talks about the different types of business entities, which is important, but it's not more important than some of the other things that we need to cover. And because time is of the essence, we're going to make sure that we go ahead and at least cover what we need to first. And so we're going to jump right into chapter 6, which is the role of money and the part money plays in the economy. Especially relevant given right now, we just barely today saw that stimulus checks went out because of the current economic situation. A lot of people out of work, or at least temporarily out of work. And so the government sent us a bunch of money, hoping that would fix the problem, which it will, for some people, give them money to spend. It's really just a cash advance on next year's taxes, but we don't talk about that because that's really not a stimulus, so to speak, other than the fact, well, I should say it is a stimulus, but it's not free money. It's money that's already going to be your parents. So every adult got $1,200 that filed taxes. Every child in a home under the age of 17 got $500 through their parents. So you might want to go to your parents and find out where your $500 went. Just kidding. And that's supposed to be used to stimulate the economy by actually going out and spending it. So as we talk about the role of money in this chapter, keep that in mind that we're not talking about the role it plays in terms of monetary policy, because we'll get into that a little later. Monetary policy means the decisions that government and the banks make in regard to money and how it affects the economy. We're talking about actually the physical role of money, okay? So as you see on this slide, money is used for three different reasons. It's used for a medium of exchange, a unit of account, and a storage of value, okay? It allows you to transact business, essentially. As a medium of exchange, it allows you to create value. So when you go buy a pair of tennis shoes and you get charged $200 for that pair of tennis shoes, then you're exchanging a piece of paper or several pieces of paper for something of value, something that actually has intrinsic usable value. Which brings you to the next, which is a unit of account. It allows you to compare two goods that may be separate but have similar value. $200 for a pair of tennis shoes is equivalent to something else that also costs $200, like a grocery cart full of groceries that can feed your family for 2 weeks. So those two things, even though they're not anywhere alike in terms of items, they are alike in terms of value. So money creates that value, or the comparison of value. And then you have a storage of value, and that is that when you put that money away somewhere, that when you pull it back out, it has at least similar value, or hopefully more value, probably less value because of inflation, but we'll talk about that later on. If you were to, for instance, back in the day, when they used different things for currency rather than just actual money, let's say, for instance, you use beef as a currency. That beef only has a certain length of time that it's good for, particularly back before we had refrigeration and freezers. If you give someone a half of a cow, they better be able to eat that or turn it into jerky in a short period of time. Otherwise, it's not going to have the same amount of value. It's the reason why you guys don't put gallons of milk in the bank, because I can't imagine what a gallon of milk would look like a month from now after we go and try to pull it out of the bank. But if you go put a $10 bill in the bank, you can go back 30 days later or a year later and pull that $10 back out. And it's still going to have some value. It's probably not going to have the same amount of buying power, but it is going to have value. And that is unless the government goes away, and that's a whole different discussion. So the coin and paper bills that we use are called currency. So currency and money are similar. but currency is actually what we use to exchange, whereas currency is a type of money. Cattle, we've used a lot of different things as currency over the time. Um, I should say money is a type of currency. We've used cattle and salt and fish and beads and fur pelts. We've used whiskey. We've used a lot of different things for value. As a matter of fact, you guys probably have used different things for currency. I remember when I was a kid, we had a marble collection, and that was a big thing, or baseball cards. And I still have some baseball cards. And you used to be able to trade those with each other, and you would get different items of different value. Like, I've got this really rare marble, and I'm going to trade it to you, but you're going to trade me 5 of your normal marbles for it because it's of such value. We see this all the time happen now with like Pokemon cards and action figures and Barbies and all these other things. Those are all forms of currency because we actually trade those back and forth for different values. Okay. Money itself, however, not currency, but money is durable, portable, divisible, uniform. There's a limited supply of it, meaning you can't just go out and print it nonstop, because that would bring the value of it down. Again, we'll talk about monetary policy later on. Okay, and it has to be accepted as a form of payment, which is interesting because given right now, there's a lot of places that are not accepting currency because of the possibility of it having germs or virus on it, which technically I believe is illegal because you still have to be able to take currency from people if it's legal tender. But I think we're being a little more lenient right now because of the medical worries that we have. A lot of things in the past, like I said, have been used for different currency. This is a belt that was used, a wampum belt, in Native American cultures for currency. Here's all the different ways in our American currency you can divide $5 in all these different denominations. So it is divisible. Okay. And think about the durability of your money. You can actually put a dollar bill in the wash and pull it out and it's clean and it's not falling apart. That's because actual money is cloth. It's actually 100% cotton. It's not really paper. And if you're ever interested in watching a good documentary, there's a good documentary on YouTube about how money is actually made and printed. There's a lot of different steps that it goes through. Okay. So there's lots of different ways that we can divide money, as was mentioned in the previous slide. Coin makes that possible. A lot of people have talked about getting rid of the penny. Well, the reason the penny's there is because of really mostly our electronic banking, and not necessarily because of our physical need for it because most of us just leave the pennies at the counter anyway. So the term fiat money is important, and fiat money simply means this, that it has value because the government says it has value. If you look at currency, pennies, nickels, dimes, there is not a lot of valuable metal in those anymore. They're not made of true 100% copper or 100% silver. They're usually made from tin or other types of alloy material that don't have a real intrinsic value, so to speak. You can't go in and melt them down and put them into a bar and get any kind of precious metal value, but they have value because the government says they do. And as long as the government's backing that money, then it has value. And that's what fiat money means. I love this comic as to why money was invented. Well, it was invented because it'd be really hard to take certain things that used to be counted as currency and trade those in our modern world. I think it would be very awkward to carry in a big bag of salt and try to buy yourself a Italian ice at Carrie Ann's. I don't know that they would accept it, number one. And number two is I don't know if they could store all the stuff that they have that they get in on trade. So, and that brings us to why the American banking system was created. The banking industry has gone through a lot of different iterations. It started in basically in 1791. The first bank of the United States was established, had a 20-year charter. A charter just essentially means a license to do business, a government license. And then that was not renewed in 1811. And so for about 5 years, you had a lot of different banks popping up. Just imagine in Rexburg, if every single bank or credit union that's here in Rexburg had its own currency, and you could only take Beehive currency to Beehive, and you can only take Wells Fargo currency to Wells Fargo. Well, that's essentially what we had. There was no centralized monetary system, and there was no centralized bank that would control that money. And so you had a lot of chaos going on. Yeah, it was a lot of freedom in terms of being able to do business however you chose to and with whoever you chose to. And there was not a lot of government control, which a lot of people would be happy about in today's world. However, it made for a lot of chaos because there was no centralized money, so to speak. And then in 1816, the Second Bank of the United States was chartered for 20 years. And 20 years later, President Jackson vetoed the rechartering of that bank. And he did not want a centralized bank. And we had free banking. Again, 30,000 different types of currency at its peak in American history. 30,000 different currencies. So you could go to Walgreens, and Walgreens would have its own currency. And you go to Brolams, and Brolams would have its own currency. And yeah, you could use some at another place, but you would not get the value of it. For instance, if you had a dollar bill from Brolams, and it was a Brolams $1 bill, you could go and sell it, or you could go and spend it at Walgreens, but Walgreens might only give you 25 cents value for it. And so, and then Walgreens have to figure out how to go get its value back from Brolams. And so it was a lot of, as a matter of fact, at one point in time, Dr. Pepper had its own currency. So if you went in and actually bought a Dr. Pepper, you would use Dr. Pepper currency. And we had a lot of chaos after that free banking era began. And that was until about 1863. And that's when the National Banking Act established a national banking system and a national currency. First time we had a national currency. And then something interesting happened, and it doesn't show on this particular slide, but in 1907, we had a big run on the banks. And it was similar to the Great Depression, but it wasn't as, it didn't have as drastic of an effect, but it did something very, very important in American history, particularly pertaining to banking. And it started because one banker, J.P. Morgan, didn't like another banker, the Knickerbocker family, and he started a rumor about the Knickerbockers. And because of that, everybody who had money in the Knickerbocker Bank went and tried to get their money out of the Knickerbocker Bank. Well, back then, the only reason that banks were in business is because they held people's money. If they didn't have your money in their bank, they had no purpose. They had no money to do other business. Any of you ever seen the movie It's a Wonderful Life and remember Mr. Potter? Well, Mr. Potter was a banker. And Jimmy Stewart, his character, George Bailey, was a savings and loan, which is a little like a bank, but it usually just means that they have money in their bank because you deposit it, and then they turn around and loan that money to somebody else to build a home or buy a car. But that's the only reason they have money, is because they have your money in their bank. Well, what happened in It's a Wonderful Life is when Jimmy Stewart, George Bailey, lost some of the money that had been deposited in his bank. He had no way to give those people back their money that they had given to him to store. Not only that, but when the Great Depression happened, which is what era that movie is based upon, everybody ran to the bank to get their money out. Well, where was their money? Well, their money wasn't in the bank. Their money had already been loaned out to somebody else to build their home. So for me to get your money back, I would have to go to the other person and get money from them that I loaned to them for building their home. And then I would be able to pay you back your money. And if everybody did that at one time, there wouldn't be any money to give back. And so in 1907, when this rumor was sent around by J.P. Morgan about the Knickerbocker Bank, everybody ran to the Knickerbocker Bank and started to get their money out. And so the Knickerbockers had to close their door. Well, as soon as they closed their door, what happened to all the other banks? Well, people started to panic that maybe their bank was next. And everybody went to those banks to get their money back. And literally, the only banks that were to survive something like a run of banks of 1907 or the Great Depression of 1929 was for the big banks to essentially buy out the little banks for pennies on the dollar. And so big banks like JP Morgan turned around to all these little banks and said, you know what, we'll help you out. And we will give you money to pay these people back their money. But we're only going to give you back 50 cents for every dollar. And essentially, we own your bank for half of what it's worth. And that happened in 1907. It happened again in the Great Depression. And because of that, in 1913, President Wilson actually signed what's called the Federal Reserve Act. And there's a lot of history behind the Federal Reserve Act, and I'll leave that to you to do some more studying on your own. But if you want to see some very interesting conspiracy theories, go and read about the creation of the Federal Reserve Act and who was behind the creation of it, how it was created, and who proposed it initially. And it brings us to what we have now, and that is a centralized bank that has 12 member banks. And then of those, they have, I think, 2,500 other banks that are kind of have ownership in that system. And they control all of the money in America. We think it's government that does. Government has a little bit of influence because the president or the chairman of the Federal Reserve Board is assigned by the President of the United States, but that's one vote among a whole board of people who are part of these member banks. So the banks themselves actually control themselves. So they don't have a lot of government oversight or government intervention. There's a little bit built into law, but they audit themselves. They control their own monetary policy, which we'll talk about later in terms of interest rates, supply of money. But that began what's called the modern banking era, which is what we have now, which is a centralized bank that controls all the supply of money. And then your little bank in your little town has a little piece of ownership in that system. And they essentially store your money and loan you money. Now, credit unions are more of a modern development. They're essentially depositor owned, meaning when you put money in that credit union, you actually own a piece of that credit union. But they still are part of the Federal Reserve System in the fact that their money is stored and actually is loaned from that system. So, and then you can see from the slides here, we've had lots of different deregulation periods, regulation periods of the modern banking system. Alexander Hamilton was a Federalist. He was a staunch supporter of the federal government having a strong central bank. And he on the other side was on the other side of the argument from several people during the founding fathers days who did not want a centralized bank like was in the Bank of England. So they didn't see that as a positive thing, having a centralized bank. But like I said, imagine a world without a centralized bank. We'd have a lot of different currencies. It would be interesting to see how it would act and how it would function in today's world. This is a $10 bill from the Confederate States of America. Has very little value now, other than in collection. It'd probably be worth a lot if you actually had an original one of these. But it does not have any monetary value in our Federal Reserve System. Been a lot of banking reforms over the years. All of our money used to be based in gold. All the gold in Fort Knox was stored there to give our money value. And it does not function that way anymore. It is all fiat money, meaning that our money has value because the government says it does, not because there's any gold sitting anywhere. There still is gold in Fort Knox, but it does not back our money or any other government's money. Most of those governments base their currency on the dollar bill or on the euro. or some other type of currency. Um, we talked about the panic of 1907. Um, there was a lot of banking regulation following the Great Depression, which is a good thing in terms of this particular case. It's not necessarily, it almost necessarily wasn't needed, because after the Great Depression, there were very few banks. A lot of the smaller banks failed, and a lot of the larger banks just bought them up. But for 30 years, those banks that were bought up were heavily regulated by the government. And then in the 70s and 80s, we did a lot of deregulation of banks. And deregulation means we took a lot of laws away that limited what they can do. That was positive and negative. Positive in the fact that it gave banks a lot more leeway to loan people money, particularly high-risk people. The bad thing about it is they loaned out a lot of money to high-risk people at high interest rates and took advantage of those people. And those people eventually weren't able to pay those, and it caused a lot of financial turmoil, a lot of defaulted loans, and a lot of people lost their homes in the savings and loan crisis in the 80s. We then again saw that in the mid 2000s, which was part of the Great Recession that a lot of you were probably very young during the beginning of. And usually those come with some kind of bailout or government intervention to try to bring us back to equilibrium. One of the things that led to the Great Recession was what we call subprime lending. Subprime lending means this. Let's say, for instance, you go to a bank and you ask for a loan. The first thing they do is ask for you what your credit score is. And your credit score is a number that's created that kind of indicates how much of a risk you are. If I loan you money, do I have a good chance of getting that money back? And the higher the credit score usually means, yeah, you're going to get that money back. The lower the credit score means that you're a bigger risk. In the past, something has happened that has caused you not to pay something back. And so banks may still loan you money, but they're going to loan you at a higher interest rate. Meaning, interest rate meaning if I loan you $1 and I say, I'm going to give you this dollar, you're going to pay me back 10% interest. When you pay me that dollar back, you're going to have to give me $1.10. And we can set whatever rates. Maybe you're going to pay it back to me in a month or a year. And so banks do the same thing. They loan you money to buy a car, and then you pay them back that every month for 5 years. And then for a $10,000 loan, you've paid them back, $12,500. And so they've made a little bit of interest on your money. And so subprime mortgages basically means I'm going to loan you money for a house, but you're a high risk. So therefore, you're going to have to pay me back double what somebody with good credit would, which to me kind of flies in the face of what really should happen. If you have a harder time paying back loans, you should get at a lower rate, but that's not the way banking works. Banking, they want their money, and so they're going to loan it to you at a higher rate. And so they loan you money, and you can see here in 1999, only 2% of all mortgages that were lent out were subprime. Well, something interesting happened here in the early 2000s. Our economy was doing really well coming out of the post 9/11. And we started to do really well, but we wanted more people into homes. We wanted more people who haven't been able to afford homes into homes. And so the legislature got together and said, we are going to force banks through regulation to loan out more subprime loans. Now, one of the unintended consequences of that is, okay, we're a bank, we're going to loan out more subprime loans, but we're going to do it at a high interest rate because there's no law against that. So you're telling us as a legislature that we've got to loan out money to people who haven't been able to pay it back, but you're not telling us we have to do it cheaply. And so they loaned out a bunch of money. And of course, people who had poor credit or, harder time paying back in history, As soon as the economy started to slow during the 2007, 2008 time period, they stopped paying their mortgages. And when they stopped paying their mortgages, those banks were unable to pay other people back the money that they had deposited with that bank. And so it caused a lot of bank failures in the Great Recession because those banks had loaned out money to people who couldn't pay it back. And then as soon as the economy took a dip, those people couldn't pay those mortgages. And that therefore the banks failed because they had too much debt outstanding that was bad debt. And that caused a big crisis in the banking industry, which is why we had the big banking bailout of 2009. And that all happened because of these subprime mortgages that you see here listed on this graph. Okay. The Federal Reserve System is set up to oversee all banking. We'll talk about that tomorrow. Actually, on Wednesday, we'll talk about that. So we'll go into greater detail, the Federal Reserve System, and kind of break down how it is. I'll actually be putting out a video on that, on how the Federal Reserve Bank works. So you'll be able to actually watch that video. But this will give you enough information now to complete this week's assignments. Again, watch for that video on Wednesday on the Federal Reserve System. And if you have any questions, again, feel free to shoot me an email, and I can answer those questions for you. Your assignments for this week are under the activities and assignments link on the website. So make sure you get out there and take a look. Otherwise, have a great week, and look for additional content online under under Unit 6.